Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Okay, we're back again. You know, some people ask me, why do I refer to certified financial planner when I'm saying contact a qualified professional? I don't represent certified financial planners or any organization, but the reason I say that is most people call themselves financial advisors, and a financial advisor can be anything. You don't have to have any specific training to be able to call yourself a financial advisor. So I may see life insurance agents who are brand new in the business, 1 month licensed, referring them to themselves as a financial advisor. So I'm cautioning you to make sure that you're dealing with advisors in your world, that you surround yourself with seasoned financial professionals, seasoned tax professionals, and seasoned legal professionals who have reached the highest levels in their fields. With the certified financial planner, the reason I keep referring to that is I know there's an accelerated level of learning and studying, resources, training, and competency tests that a person has to go through to at least reach that level. Being a certified financial planner does not in any way mean all certified financial planners are competent in all areas, but it's at least a good start. So test people by their credentials, things like that, to find out exactly who you want on your team. But that's why I say that, because I think it's a good start to get someone well-versed and at least who has shown competency in their training to a higher level than just a financial advisor or so-called financial advisor. Okay, the next thing I wanted to get into on this life insurance programming was we just got through burial costs, and another reason people, when they're programming needs, might say they need life insurance, the next step, logical step, would be, hey, if anything happens to me, I want to pay the bills off for my spouse. If anything happens to me as a business owner, I want to pay the bills off of the business. So when we get to that, let's take the husband and wife situation to keep it simple. Husband dies, for example, and the wife is left, and let's take an example where the wife does not work. So we have a situation where now you want to take care of making sure that your spouse does not have any financial burdens. So you've taken care of your burial costs, and now we're taking care of the bills. So what are the bills that you could pay off? Usually cars and usually house. On the cars, the first thing is I'll ask people, okay, how long do you need the life insurance for your cars? And they'll say, well, till the loans are paid off. And I'll ask, how long is that? They'll say 5 years or whatever. And I'll say, okay, so you need 5 years of life insurance to pay off the loans? And they'll say yes, and I'll say no. And they'll ask why, and I'll say, a car loan is a lifelong loan. They'll say, no, it isn't. It was a 5-year loan. There are only 3.5 or 4 years to go on it. And I'll say, listen, is this the only car you've ever owned? They'll say, no, the car before this, et cetera, et cetera. And I'll say, did you have a loan on that car when you bought it? Well, yeah, we did, or we leased. And I'll say, okay, if I had insured that loan on the other car, then when you traded it and bought this car, wouldn't I have had to write another brand new 5-year life insurance policy to cover this? And they'll say, yes, I see where you're getting. I see where you're getting to. So I'll say, once this car loan's paid off, you're going to buy another and another. Well, if something happens to you, and we're trying to protect your wife, cars get old, they wear out, they are costly on maintenance after a while, and your wife, in this example I'm using, will continuously have to re-buy cars. So when we say car loan, we have to think the eternal car loan. So I want you to think about that, because a lot of people miss that in life insurance. They say you only need this much to pay off your loans, and they take the term of the loan. Now that, I will give you a bit of advice. When you have a car loan, sometimes you want to insure it with life insurance. You contact your life insurance company or your life insurance agent, and they say, we can't get you life insurance because of the health condition that you just had, or the surgery or operation that you just came out of. And you'll say, oh my goodness, now what do I do? When I need it the most, I can't get it. And the answer sometimes is, the next time you get a car loan, see if they offer credit life insurance built in to the car loan. And if they do, also see if they have credit disability insurance. The reason I bring that up is this. The medical qualifications for that type of coverage built right into the car loan, many times they won't ask any medical questions. They'll just say, do you want the life and credit insurance? However they're going to phrase it. This is your loan company. Always X yes if to the life and the disability, especially if you have a medical condition. Now, if you don't, and you could buy life insurance less expensive on your own, and it's long-term life insurance, whatever your needs are, you may be better off buying it elsewhere. But always X yes on those credit applications if you think you might have trouble getting it on your own. It may be an opportunity for those of you who are medically uninsurable to actually buy insurance. And it's the same thing on mortgages. Many mortgage holders, the banks, the credit unions, the mortgage companies, offer you the opportunity when you first take the mortgage to actually X yes on those boxes and have instant coverage. You're paying a premium for it. Might cost an extra $50 or $80 a month. It's not always cheap. But especially for those of you who are uninsurable because of some medical condition or unable to get insurance for any other reason, it might be a very good way to get those loans covered and paid off. All right, now, that's the tip on the loans. And then what we do is we have to get into a theory. And here's the theory. If you have a mortgage and you have a car loan, isn't it true that if you buy a car for $25,000, 3 and 4 years later, you don't still owe $25,000 if something happened to you to pay off the loan? Might be $5,000 or $8,000. So you have a decreasing need as those loans begin to mature and get older. As they get seasoned, you continue making the payments, you continue paying the principal down. We used to have a term insurance policy called a decreasing term death benefit. So the life insurance policy premium would stay the same, but it would be a lot less expensive than regular term insurance because every year the amount of insurance would go down according to the amortization of the car loan or the mortgage. That's called decreasing term insurance. I haven't seen that for a lot of years now because level term insurance is so inexpensive. But I wanted to point that out to you because you truly have, in those cases, a decreasing need. As time goes on, you have a decreasing term need. So keep that in mind when you're looking at the life insurance. It's just something you want to keep in mind. All right, let me take another quick break, and we'll be back to wrap up.
Most would agree that no one could put a monetary price tag on our lives. You and I are truly priceless. However, the cost to our loved ones could be dramatic if we don't prepare for the challenges they may face should we pass away. Driscoll Insurance and Financial Services has a great tool on their website, driscollfinancial.com. When you click on the link for a free life insurance quote, you can see the different opportunities available for term life insurance from several providers, including some well-known companies. All you do is answer a few questions about yourself. It literally takes seconds, and you may be surprised to see how affordable term life insurance can be. Experts recommend that you carry life insurance equal to 8 to 10 times your annual salary. So what are you waiting for? Go to driscollfinancial.com and get a free quote. And while you're there, check out the vast array of services that Jack Driscoll has to offer. Or call his office in Bethel Park at 412-833-1500. That's 412-833-1500. Driscoll Insurance and Financial Services. Insure for today. Invest for tomorrow.
Okay, let's get back into this discussion. We're talking about a family, let's say, and we have this husband and wife situation that I brought up before. And let's take that a step further. Let's say the wife is at home and not earning gainful employed income because of raising the children, let's say, and the husband dies prematurely. Now, if we have a mortgage, we might typically look and say, for example, we had a $100,000 mortgage. We might typically look initially at the $100,000 death benefit policy, properly matching the need to pay off the mortgage. And we wouldn't be wrong. What I propose is this. There are other alternatives, maybe better, maybe not, but there are other alternatives to look at. Number one, do you want your wife at home having no mortgage, but also maybe having no credit because they haven't had a chance to build credit themselves? So if something happens to you, they might find themselves in a situation where they try to get a credit card and are unable to do so because they don't have any credit built in their name. We ran into that a lot 20 years ago. We don't run into that as much now because a lot of two-income families exist now where that wasn't necessarily the case 20 years ago. But in those cases, let's take this example and look at some alternatives. One, we have a $100,000 mortgage. Let's say it was a 30-year mortgage at a 4% interest rate. Roughly projected the mortgage payment without taxes, without any insurance, but just the principal and interest. Let's say the mortgage payment would be about $477 a month. Now, if that's the case, I propose to you an alternative way to look at the situation. Not that it's right or not. Let's say we have that mortgage for 30 years. 5 years later, the breadwinner dies prematurely, leaves two young kids at home, and the mortgage and the car payment. Well, we just talked about the car payment, so let's talk about the mortgage. One option would be to take $100,000, pay off the mortgage. Because, as I said, 5 years is already paid toward it. It may only take $98,000 to pay off the mortgage. As you know, you have a 30-year mortgage, you pay 5 years, almost all of it went toward interest. So the loan balance is still up there pretty high. But when we do that, and I have a situation, I might want the wife to keep the mortgage, keep making the payments, and provide a lump sum asset that at interest, that's earning interest, and have the interest make the mortgage payment for her. So in essence, I've paid off the mortgage or taken the mortgage burden from her without actually paying it off with the mortgage company. But I've had the same benefits. It costs a little more to do this, so just evaluate both and decide what's best for you. Here's how the numbers might work. We have $477 a month is the payment. And if I had any lump sum of money, I might not be able to count on earning any interest higher than 3% if I had to be safe to figure out how much could I earn on that sizable amount of money. I might say, or project 3%. We're going to be wrong. It might earn more, it might earn less. We may never even need it. But as a rule, let's say if it did earn 3%, I would need how much money in the bank to make a $477 a month payment. And that's how much money or how much life insurance you'd need to buy. So I did the math for you in advance. $477 a month is 3% interest on $190,000. Now, here's what's interesting about this solution. First, it costs more for life insurance because we'd be buying $190,000 as opposed to $100,000. But I'm solving a permanent need my wife has. Now, notice I didn't say I'm buying permanent insurance. Whether I'm buying term insurance or universal life or whole life, I'm just buying for her permanent need rather than just a one-time need of pay the mortgage off. Do you see the difference? If we have a $190,000 death benefit, does your wife receive that, in this example, income tax-free, or does she owe taxes on it? As we've talked about, it's income tax-free if payable to a beneficiary. So she has $190,000 in the bank. She finds a way to create a structure of 3% interest. She'd talk to a qualified financial professional and see if that option's available to her or not. But in this example, let's say she finds that at a rate of 3%, every month she's receiving a check equal to her mortgage payment. I'm discounting income taxes in this situation because everybody's situation is uniquely different. One person won't have any income tax to be paid if they're a survivor because they have very low income, and another may have very high taxes to be paid. So I'm discounting taxes, and for this example, she'd have $477 a month coming in, and she'd have $477 a month going out. So in essence, this investment, which was funded through life insurance, the interest on the investment is making her mortgage payment over the next 25 years. Where are the benefits? Number one, if you look at mortgage interest, that is a tax-deductible expense if she itemizes her deductions. And if her income is lower, she'll be able to itemize and have a greater value possibly to that itemized deduction. We never know. But it's an option that she can deduct. It is a deductible expense that she's making the payment. Number two, the income may be taxable depending on her tax rate. Number three, the interest only in this example and scenario is making the mortgage payment for her, and the whole $190,000 is staying intact. Now, what does that mean at the end of 25 years? Does her mortgage payment go up every month over the 25 years? No, the mortgage payment does not go up. The mortgage payment is locked in. It's a 30-year amortization. So some of you listening are saying, wait a minute. No, the mortgage payment does go up. And I'm telling you, no, the property taxes and the insurance that are held in escrow go up, but not the mortgage payment. So keep that clear and keep that separate. I'll refer to that again a little bit later as to why that's important. So she has a fixed cost. What if her savings account earns greater than 4%? Let's say inflation comes back and interest rates come back up with a bang, and they earn 4 or 5%. Her fixed cost is still based on only the first 3% interest from that account is necessary to make her mortgage payment. So if she's earning any more than that, she gets to keep it in the account, have that be reinvested, and in fact, potentially grow the $190,000 bucket if that is indeed the case. So we have at least a chance of being able to grow that account for her future needs after the mortgage is paid off. That account is still intact. So that's pretty good. And in addition, she's developing a history of making the mortgage payments, and that could be very beneficial. So you look at the whole situation. Tax deductible, whether it's better or not, is not the issue here. When we're programming life insurance needs, what we're doing is we're really analyzing alternatives and trying to make sure that we don't miss any possibilities or alternatives in helping make good decisions. We're not saying one decision is better than any of the other. We're just saying we're trying to evaluate all the choices before we try to make what might or might not be the best one. But that's a darn good one to consider, because at the end of the 25 years, what does she still have coming in? That's right, a steady income. In this scenario, if all things hold true, a 3% income, $477 a month for the rest of her life, if that principal is kept safe and intact. And again, if it's earning more than the 3% at any time, it's reinvested. The risk is if it's earning less than the 3%, maybe it's only earning 1%, and she has to draw 3% out to make the mortgage payment. Well, again, remember the mortgage balance is $100,000. So if it gets down too low, she can indeed, 190,000 gets to 170, gets to 150. She could take the 100,000 out, or then what might be 95,000, reverse course and just pay the loan off. So that allows additional flexibility for a spouse. That is a good planning option as opposed to just the obvious, which would have been pay off the mortgage. All right, now, Why else might someone need to buy life insurance or think to buy life insurance? Remember, this whole discussion is programming needs. People buy life insurance, again, back to my premise. Everybody has $100,000, let's say, and that can't have been tailored to most people's needs. So that's what the process is we're going through here. When I say program the needs, I'm just giving you a couple examples. Here's another one. You have little kids at home. What's the greatest goal some parents have for their little kids when they grow up? To go to college. So if something happens to the breadwinner, that may go out the window. Or you may be saddling and burdening the kids or your surviving spouse with huge student loans if they choose to go to college, where you, for a very small expense, thinking in advance this early, might have been able to simply create a fund of $180,000 for maybe a couple $100 a year. Would you buy insurance for a couple $100 a year if it meant that something happened to you prematurely, your kids could still go to college without burdening your spouse and without taking on loans? What a great gift to give to kids, your kids, and grandparents, those grandparents of you who are listening. Think about life insurance on yourselves, with the grandchildren as beneficiaries to get them through college. What a lasting gift. And I know some of you grandparents listening and watching are saying, wait a minute, it's too expensive at our age, or we're not able to qualify. Then why not consider purchasing life insurance on your children, which are their parents? The parents might not be able to afford that extra life insurance. You as grandparents want to give a gift. And instead of giving a gift of, let's say, $1,000 a year to the kids or the grandkids every year, you might want to give a gift of $1,000 toward a premium a year that insures the parents for $180,000 or so, should anything ever happen to the parents, that the kids would still get to go to college. Or better yet, insuring your lives as grandparents to help fund that cost. So there are a lot of different opportunities for you to make lasting gifts. Now, most life insurance can be seen as self-fulfilling and self-completing the financial goals that you as the caregivers and the primary breadwinners were intending to accomplish over your life, if you're given your whole life of earnings to accomplish. But what these are, the life insurance is an option and an opportunity to have self-completing goals. It self-completes the goals automatically. Should you die prematurely, it takes over and makes up the loss. All right, we're almost out of time again. I did want to bring up something important. When I talk about grandchildren or children, usually when we see a newborn, the parents a lot of times say, we need to get insurance. And I'll say, on who? And they'll almost always say, well, on our new child. Well, again, I'm a why guy. So I have to ask, why do everything? Why are we doing this? Why? So you need to ask, why are we insuring the son or the daughter? Well, everybody needs insurance, and my parents bought a small policy for me, and I'm buying one for the kids. And I'll say, listen, if you want to do your kids a real favor, one way is to buy life insurance on them now in advance. That's true. Because then later, if they develop a medical condition, you'll always have they'll always have at least a life insurance policy that maybe later on in life they could never buy for themselves because a medical condition arose and they're uninsurable. So there is truth to that. But I also have to propose that if you really want to do a favor for your children and take care of them, then buy more life insurance on you, that if something happens to you, there are additional funds to take care of them. So I want you to think about that when you're thinking about life insurance. Who do we insure? If you're insuring your wife, in my example, who is staying at home, and you're insuring you, the breadwinner, or the husband that's staying at home and the wife's the breadwinner, I want you to reevaluate, why are we buying insurance on both of us equally? Should we be insuring the breadwinner for certain financial needs that the non-working spouse would have? And even if you're both working, hey, If you're living on both incomes now, there's going to be a financial hardship if something happens to either one of you. So you insure to make up the gap. And the spouses at home who are taking care of the kids, if something happens to them, hey, guess what, breadwinner? You don't go to work tomorrow. You got 2 little kids running around at home. So you have to hire people, maybe $1,000 a month, $1,500 a month to take care of them, and then get home and cook for them. And if you travel, you might have to quit your job. Or if you've provided and protected yourself by buying enough life insurance on the non-breadwinner, the spouse at home, to replace all of those chores and duties they're doing, it might equate to a $2,000 a month salary. You'll have to buy life insurance to replace that, to be able to hire out those services so you can keep your job. So think about that both ways, folks. There's a lot to this. Now you can see why I said go to a certified financial planner to help you with this rather than just an individual practitioner. All right, folks, we're out of time. I will come back next week with another edition of All Things Financial. In the meantime, feel free to call us with any questions you might have. Thanks again, and we'll be back next week.
You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through Sage Point Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with Sage Point Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.